Good evening, folks, and welcome to the Contrarian Trader. This is Robert Desmond. It is Wednesday, November the 19th, 2008. Folks, my last video I recorded on the 17th, and I referenced the importance of holding the 818 level on the S&P 500. I did believe, I was short-term bullish. I did believe that we were going to have a rally, but I made a clear point that if we broke below that 818 level, that we were going to head back down lower. We were going to break hard down to the 775 level on the S&P 500, and that marks the lows of the 2002 bottom in the bear market from 2000 to 2003. 2002 we had the initial bottom, came back down, as you can see here. In 2003 we had a successful retest of that support level, and we had the subsequent rally up to 1,576 on the S&P 500. We did anticipate back in November of 2007 that what we were seeing was a super cycle double top here, and that we would come back down and retrace these, at least 50% of these gains, and hopefully head higher. But unfortunately, our worst forecast did come true, and it looks like we are going to head down to that 775 level on the S&P 500. The Asian markets, I already took a look at them. They're not taking the news well as anticipated. They follow our markets, and you can see the Nikkei's down 357 points, which is not good. That's actually not. They're down 370 points, down 4.5%. Topic's down 3.64%, and the Hang Seng down a little over 4%. So the Asian markets are not taking this well. Let's take a look at the U.S. futures going into tomorrow. They're up slightly, but honestly, folks, I don't put all that much faith into the futures at this point in time because, what we'll wind up seeing is an early rally on Thursday morning, and then the subsequent sell-off, which I believe is going to lead us down to the 775 number. So my strong suggestion to the folks that are out there that have that are nimble and able to trade their accounts, to put a stop loss just below today's low, and the minute that we break today's low, if we do so tomorrow, let's just go to cash. There's no sense in being in this market at this point in time on the long side. If it's the intent of the market to take us down to the 775 level and to see if we can hold that low, I believe that given that it's such a significant support level, that we will hold it and that we will rally off of it. There's a lot of money sitting on the sidelines looking to come to work, but they're going to wait for a strong support level, and I believe that 775, say the 775 to 780 level, is a good entry point to get into this market for a trade. It's yet to be seen as to whether or not we can hold that level, and it could take some months before we find out. You can see this is a monthly chart here, so we bottomed out here in 2002, 1, 2, 3, 4, 5, 6, 7, 8 months before we came back down and retested. So this is going to be, there's no rush for the long-term investor to jump into this market. If you're dollar cost averaging in on this market, at this point in time, the market, it seems like a sound investment track to take. I mean, a lot of the fluff has been taken out of this market. It's very, very oversold, and I do believe that we are going to see a significant rally at some point in time in the near future. But again, I believe it's going to be the 775 level. That's going to be the support level, and not these support levels that would look like they were set up as a bull trap. This is the Russell 2000 index, and you could see we had a nice setup here for a rally. We retested this 4408 level. We actually undercut it a bit on an intraday basis, but we did rally up, and we rallied up on strong volume, and I had hoped that would be the beginning of a new short-term rally, but unfortunately we didn't get to follow through. We have a breakdown here, and from this point forward we need to remain cautious. What we also need to watch out for is the U.S. dollar. Generally, we like a strong U.S. dollar. That's a sign of a strong economy. But it's right now the U.S. dollar is being used as a flight to safety, and it's only because of the Europeans being in even worse condition than we are in right now. So it's not that the United States is doing so well. It's just that we're doing a little bit better than the Europeans at this point in time, which is not, it doesn't get me excited about going along the dollar. I would like to put money back to work in equities. We did stop out of our silver position today, so we are cutting back on our exposure to commodities, and I do believe that we will see a breakout above this 88.15 level, and what that's going to do is you're going to see a break in oil, probably head back down lower, which is good for the consumer. So what I want to start looking at now is that if we see commodities heading down at this fast of a clip, then that's going to be that much more money in the pocketbooks of consumers. Now, until now, we haven't been seeing, and the retail sale numbers reflect that the savings that the consumer is seeing at the gas pump is being spent in the stores. So what that tells me is that the U.S. consumer is doing what the United States government is not, is that they're being prudent and they're paying their bills, which is good for the banks. So the banks are probably seeing deposits build up because consumers are saving and paying off their credit cards, which gives the banks more liquidity. So at some point in time, they'll feel confident to lend. So the other sector to watch is the other retailers. With the Christmas season coming, they are extremely pessimistic on retail sales for this Christmas. So let's watch the retailers. As a matter of fact, let's take a look and see how they did today. I haven't even checked on the RTH, which is the retail holders, and see how they held up. They what is it, 64, 67? They actually did quite well today. You'll see here at 64, 63 was the recent low, and we held above it. Closed at 64, 67, which is quite a statement. If we can hold this level here, we'll be watching this going forward. And I mentioned on the 17th that we were going to be looking at Ann Taylor, Liz, because it's so beaten down. Abercrombie and Fitch is another one that we're going to be looking at as a potential trade. The one positive I see here is that the volume was light today, so it looks like the sellers are drying up in this sector. Let's keep an eye on it. If we do head down to the 775 level, I'm really skeptical that we are going to be able to hold this level on the RTH. But if we're able to, that's going to show that the RTH, the retailers, have relative strength, and that may be perhaps where we want to put some money to work in besides the overall indexes. So we may be looking at going along the RTH and the SSO, which is the Standard & Poor's Ultra Fund. So please subscribe to my channel and look for additional videos and updates to see what we're going to be doing on the Contrarian Trader. If you would like real-time alerts to our trades, subscribe to our 14-day free trial offer. Visit the Contrarian Trader at www thecontrariantrader.com, and we have a 14-day free trial offer, and you'll receive real-time trades, either buys or sells. So please stay tuned for future videos, which are, of course, free on YouTube, and I look forward to seeing you again. Good luck, and please, tight stop-loss orders. Thank you very much, folks.